Good morning, everyone, and welcome to December's market session, special holiday edition, last one of 2025. I am Paul Nullabondian, licensed in Virginia, Maryland, and DC, your local realtor expert and market guru, coming to you with all of the important economic and real estate and market stats monthly. I am joined by Temi Akoji, my wonderful colleague on the ones and twos. She is not Donner, not Blixen, not Comet, not Cupid. She is.
Ice Temmie.
Um, I had this all. I'm gonna have to fire my audio engineer, who's me. I had this all queued up. Ice Temmie.
Tis the season.
Okay, we'll just let that go in the background just a little bit. We are both actually realtors with Fulcrum Residential, one of the top real estate teams in the country. And we are proudly affiliated with Keller Williams Capital Properties, where I'm proud to have served on the ALC, going on 6 years running. Just had a wonderful ALC retreat to plan for next year. It was wonderful meeting the new folks who will be on the committee next year. Really excited about that. Temi, want to tell the folks any more about yourself before we get started?
Turn off the lights on and I'll blow.
No.
The extreme, I rock a mic like a fan.
All right. Before we jump into the content, I have a special coffee of the day today. For those of you overly obsessed with coffee like I am, you might also have a holiday advent calendar. December is the best time of the year for coffee lovers. Actually, I have two advent calendars. This one is from Tanit in Paris, formerly known as Kawa. Was able to go out to their cafes when I was out for a birthday trip year before last. It was wonderful. So have their advent calendar. Today's coffee is a Panamanian geisha. It's a yeast inoculated anaerobic natural, and it's kind of interesting. It's a Digna Nunez. He is the cultivator producer of those beans. He's actually a school teacher outside of Vulcan, Panama, and he cultivates a small backyard lot of geisha, which is world class. Like Tanit, incredible roaster. They source it. Say one of the top roasters in the United States has it as well. So it's pretty neat. That's kind of one of the things I love about coffee is the story behind it. And here we have a school teacher in Panama who is producing some of the best geisha in the world. All right, let's get jumping into this. 1 minute. Oh, forgot to mention, coming to you live today from the Dirty South. Dirty, although not really. Williamsburg, Virginia, incredibly clean and beautiful city. Actually, down here, visiting the in-laws, staying here for the week. It's wonderful. And I also want to note related to that, so I'm a little baby girl daughter, is a little bit of stimulus sensory overload, hasn't quite settled in yet. So instead of slumber party last night, we had an all-night party. I feel mildly incoherent right now. So if at any point during today's session, I am saying something that doesn't make sense to you, I guarantee you it is me, not you. Throw questions in the comments for me to clarify any gibberish I may put out there. But hopefully this could be relatively coherent and helpful. Okay, we are going to follow the same format that we do every month. If you're new joining us or watching this for the first time, we are going to start off. We're going to look at the primary drivers of the economy. And the reason we do that is because that's what impacts the mortgage market. We're going to cover mortgage rates, where they've been, where they are, where they might be going. And then we are going to jump into real estate specific data. We always first go to the most recently reported month from Bright, which is November of 2025. We're going to look at early weekly December data, the most recent data that's been reported. Then we're going to look at kind of what's happening since the government has reopened. And then we're also going to take a look ahead into 2026. What do people expect to be happening in the market? And then we're going to wrap up, as always, with key takeaways. If you could drop in the chat where you're from, whether you're an agent, if you're an agent, where you're licensed, if you're a potential buyer, seller, investor, or just somebody coming on here because you would like to add some extra excitement to your Thursday morning, let us know where you are joining us from. Also, I like this to be as interactive as possible. So please, at any point, if you have questions, comments, anything you would like to add, discuss, have addressed, just drop that in the comments as well. Starting that off with audience participation, where have people seen mortgage rates at? And this is really helpful. I'll tell you what is being reported, but what our clients, for those of us who are agents, what our clients are seeing in the real world and locking both with single family homes and condos is really helpful to share. So if anyone has a client who's locked in the last week or two, would love to hear what your rate is. Also, I'm not sure if Mark Linkowitz, our wonderful lender partner with Envoy, is with us today. He might be doing some holiday traveling, but if you are with us, Mark, you could let us know where your clients have been locking. Would love to hear that as well. Wonderful. Temi, have you had any clients locked this week?
Yeah, around low sixes. Mark was able to get one of my VA clients under 6 a few weeks ago, but right now low sixes.
Nice. Nice. Yeah, you can see that that VA and FHA, kind of as usual, they're coming in a little bit lower. So nice to be seeing some rates in the 5s. And then Mark is reporting 6 to 625 conventional, which are great rates out there right now, a little under what's being reported. The I didn't update this because as of yesterday, Mortgage News Daily was still reporting the same, like 629, 628, 627. Yeah. And that follows what I talked about last month. And you can see here, we're down about 10 bips from same time last month when we met. Rates have been in this kind of 6.2 to 6.4 band since September, and expectations are that they're going to stay within that relative band for quite some time. We talked about last month that where are rates headed, and pretty much everyone expects rates to come down a little bit through the end of 2026. I think we'll get into the 5s at some point in 2026, but no one is expecting, at least within the next year, for us to return to, the low 5s or the 4s. Probably not going to be seeing 3s anytime soon. And that could all change. However, there have been signs of a recession coming for quite some time. And if the economy tanks, then that is one thing that should bring mortgage rates a little bit down. So it's possible that could change. A lot of times when you have the job market, the bottom fall out, or some major problems in the economy, like there was during the Great Recession of 07 to 09, some things can happen very quickly. And so it's possible we can see some quicker movement, but for that to happen, we would have to see first some dramatic changes in the economy, in the job market. Speaking of, how are people feeling about the economy? And while you throw that in the chat, I'm going to touch on really quick. Do this every month. So if this is not your first time joining or first time watching the replay later, feel free to take a coffee break, bathroom break. But for anyone new, I want to explain why I spend all of this time covering the economy. And the reason I do that is because this is what determines where mortgage rates are at right now and where they're going to be. And if you understand all of this, then you can have a little bit more of an informed opinion, help your clients discuss what's happening and where they might be headed in the future. So in short, mortgage rates are determined by the bond market. And that's because most conforming mortgages are packaged into mortgage-backed securities, which are competing with other products on the bond market. And they're also competing with government debt instruments like the 10-year treasury. And the economy, what makes up the economy? And it's a lot of things, but in short, usually it's jobs, it's the labor market, it's industrial production, it's manufacturing, it's retail sales, and it is inflation. Then we also have the Federal Reserve. And so the Federal Reserve both influences and is influenced by the economy. And their levers to influence the economy are the federal funds rate. That's what we're talking about. Anytime people are saying, oh, there's a Federal Reserve meeting, there's going to be a rate cut, or there's going to be an increase in the rate, they're talking about the federal funds rate. There's also quantitative tightening and quantitative easing, QT and QE. Super short. We're going to talk about this a little bit more in a few minutes, but that's either the Federal Reserve pumping money into the economy or taking money out of the economy. And then more recently, trade policy and tariffs are a little more impactful in all of this, and so much so that they can also have some impact in the bond market. So like I said, all of these things impact what's happening in the bond market. Real quick, why I said if there's a recession, if the bottom falls out of the employment market, why this could affect mortgage rates. That's because bonds are kind of a safe haven. They're a safe investment. They're debt instruments, guaranteed rate of return, guaranteed principal, unless the underlying entity goes bankrupt, and mortgage-backed securities. That risk is spread out through all of these mortgages, and the risk of some defaults are already cooked into that. So it's a very safe investment. And when things are going bad, when people are expecting the stock market to drop, when they want a safe haven for their money, there are a variety of outlets for that. Bonds are one of them. And when a lot of people want something, you can offer a lower rate of return in order to sell those, which is overly simplified, but why mortgage rates can drop when things are going bad. And sorry, Mark, I think I saw you throw a comment up. I missed that. Yep. Yeah. Yeah. Mark is right. We're going to jump into the jobs report in more detail, but things are not looking good with the economy. Things are not looking good at all. And it's surprising me because I'm not seeing a lot out in prominent media discussing this. I'm still seeing a lot of high GDP projections, and I understand why, but it's a little troubling. So we'll talk about all of that in more detail. Speaking of GDP, so we can see our little friendly buddy Temmie. I don't think we ever named him. What should we call him? Tommy? Is Tommy K? Are you on here? Are you on here today? Our wonderful co-founder of Fulcrum Residential loves to fish. So this is a younger Tommy from back in the day. But whenever you see our little Tommy fishing, that represents the federal government gone fishing and a lack of data. So the advanced estimate of Q3 GDP was supposed to be released on October 30th, but it wasn't. They have said we'll be getting it. What are we on the 18th? So we'll be getting it next week on the 23rd. So we'll see if that comes through. Now, looking at the Atlanta GDP Now model, they are projecting a GDP for Q3 of 3.6%. That's down from 4.1% when we last met, but that's still 3.6% GDP for a quarter is a very, very robust, strong economy. As I always mention, Federal Reserve GDP Now model runs hotter than the other blue chip models. You can see that in the blue band here. Most other top models are projecting anywhere from 2 to 3.5% GDP for the quarter. 2% GDP is still a solid quarter. That's a very, very solid quarter. Definitely, positive economic growth. So if that happens, the economy will keep humming along, and people have been projecting a recession for quite some time, and the economy just keeps exceeding expectations. The job market keeps exceeding expectations until very recently, which we'll talk about very soon. So we are the CPI numbers, and if you can excuse me for a minute, I'm going to pop over. They should have been released right when we were starting at 8:30. And I'm taking a quick peek to see if they have been. Timmy, do you have anything fun and interesting you want to share while I'm pulling up what are hopefully the recently released CPI numbers?
I want to talk about the economy. I think people are kind of coming into the norm of things. Things are kind of settling in a little bit. I'm not hearing as much of a "I'll wait for the interest rate to drop" type of situation. I think people are kind of getting settled into the fact that this is the new norm. So it's it is what it is. Yeah. I don't know what are you guys seeing? Are you guys seeing kind of people settling in? Are you seeing and then also I think what I'm seeing, especially in my area, and you've been reporting about this for the last few months, is like a high dropout rate when it comes to under contracts. We'll talk about that later, but um uh I'm now like firming up on home inspections because I feel like that's been a big thing that's been happening where it's like, something's wrong with the property, not even fighting for the home inspection, not even asking for things, but just walking away is something big that I've been
Mm.
seeing. I'm not sure if you guys have been seeing that in your area. Yeah. So
All right.
yeah.
Apologies, Tammy. I wasn't listening to any of that because I was digging into the CPI data. It was released. The 1 month change was up 0.2%, and the 12 months was 2.7. So, like 2.7, the Fed would like to see it at 2. Those aren't great numbers, but they're not bad. They're fairly solid numbers. Um, the good stuff. Good stuff. Thank you, Mark. So the October data was supposed to be released previously. That's never going to come. The Bureau of Labor Statistics basically said, just, we're not getting October data. We're not going to have that. They weren't able to collect that during the time. They're not able to go back and do that. So we do have November data, which is a little higher. I want to go. They didn't release the Bureau of Labor Statistics, so they just released, like minutes ago, they released the CPI data, the latest inflation data. They haven't yet released this chart for November. And I want to go back into this 2.7 all items 12 months and 0.2% increase from the prior month. To me, that doesn't sound right. That doesn't really sound right. I think the actual numbers are probably a little higher than that. And one of the problems is, we've been talking about for months, but for anyone new, going to hit on really quick, like the inflation data being reported by the government right now is as questionable as it ever has been. And the reason for that is super quick. There are all these price checkers that go out and they check on prices of specific things in specific areas. If they can't find the price of a specific thing, then they do what's called different cell imputation. It's an analysis done at a higher level, essentially where they take the same product from a different area of the country and then do an assessment of what the price change would be, and they tag it with that price, or they find something similar in the same area and they adjust based upon that. So it's an educated assessment, an educated analysis, but it's also a guess. It's an educated guess. And historically, the component of educated guesses within the CPI numbers were less than 10%. You can see on this chart, they have been creeping up within the past 6 months. They've basically been at a third or higher. For September, they were at 40%. My guess is, with the government shutdown, I wouldn't be surprised if November's data had 50% different cell imputation. And if that's the case, even if it was at 40%, it means that near half or half of the data that goes into the CPI is just guesses. So how accurate do you think it's going to be if half the data is comprised of guesses? So I think that 0.2%, 2.7, that sounds a little questionable to me. Okay. So I mentioned last month that we would likely never see an October jobs report. And so that was officially the case. The September data came out the day we met last time. And so we didn't really talk about it. The November report came out this week. And so while there was no official report for October, that data was released as part of a joint economic committee. And so we do have kind of some rough numbers of that. The breakdown is roughly, and Mark touched on this, so we had 119,000 jobs added in September. And that's at the lower end of where we've been at for the last couple of years. Then in October, we lost 105,000 jobs. The most recently reported numbers that just came out were adding 64,000 jobs. And this is showing, you can see, just look at the chart here you have on the right end. We had very robust jobs added month after month after month after month. And then we come into this stretch of the last 6 months here, and things are looking a little more dire. I want to jump into unemployment rate, and then we'll talk about all of that in more detail. So unemployment rate, oops, I think the candy cane might be blocking that just a little, but the unemployment rate is at 4.6%. Doesn't sound too much higher from the 4.4% of September, but it is the highest rate in 4 years. And looking at this, so going back to just seeing where jobs added have been at for the last 6 months, it's clear as day. It's a softening jobs market. Now we're at the highest unemployment rate in 6 months. And I want to jump ahead to the federal rate cut. So the Federal Reserve cut rates, and the market was a little bit uncertain as to whether that would happen or not. Was not clear at all. They ended up cutting rates, and the major reason is this jobs market. And the data itself doesn't present a rosy picture. But Chairman Powell came out and said specifically that the Federal Reserve believes that these numbers are actually overstated. And they think that the official numbers being reported by the BLS have been overstated by about 60,000 jobs a month. And so, given that the economy has only added 40,000 jobs a month since April, we're essentially looking at, according to their assessment, a net loss of 20,000 jobs a month since April. So, what already looks like a bleak picture from the data is probably even worse. And not to get too far into the weeds, but I just want to say this specifically, this isn't necessarily a current administration thing, pressure from the White House to cook these numbers. It is not that at all. It is basically there's a statistical kind of model that the Bureau of Labor Statistics uses to estimate new jobs from newly created businesses and jobs lost from businesses that have closed. They're not able to collect that data directly. And so they have a model that estimates that. It's called the birth death model, and it's not very good. It is believed that this model overstates jobs that are created as a result. The Bureau of Labor Statistics has actually announced that they will be adjusting that model come January. So in all likelihood, it's like it already looks like from the data that it's a soft jobs market, and it's probably even worse than the data indicates. So with, and I don't want to like keep like, just going on and on about this too much, but we're now in midway through December. If we continue the current pace, and not a whole lot can change in the next couple of weeks, but we are on pace for the weakest year of job growth since 2020. And you might say, yeah, Paul, 2020, that's not too long ago. Yeah, it isn't, but that was when a global pandemic hit and unemployment just shot through the roof in a relatively short amount of time. And so there was a stretch where it was just massive unemployment up into the teens. And next to that, the most recent time that we had such a weak year of job growth, it was, I believe, 2009, the tail end of the Great Recession. And so while things might seem semi-normal, if you're not out there looking for a job and have been for the past year, which I know a lot of people are, the economy and the jobs market seems relatively normal to you, just know this is the weakest jobs market, like I said, since the massive economic upheaval of the pandemic and the Great Recession. So I would expect there to be continued softening of this, and that should push mortgage rates a little bit down and could push them down a little farther than what we've talked about, but just something to keep an eye on. And before we kind of move on, I want to just touch on, like I said, so GDP projections. GDP now has a GDP of 3.6. I think the odds of a recession, they had spiked up to 40% when all the tariffs were just being piled on. Things were looking a little bleak. Now, kind of the general consensus is 25% chance of recession in 2026. So how is that possible? We still have inflation creeping up. We have all of these other economic indicators, which we're going to go to in a minute, showing a weakening economy, but we still have robust GDP projections and decent numbers in that. And the reason is that the economy is very uneven right now. So you have high-tech sectors and large states like New York, California, Texas, really pumping up the economy. And so I talked about before that there was an estimate from Moody's chief economist that 22 states and the District of Columbia are currently in a recession. And that's kind of, I think most economists would agree with that you have certain segments of the economy and certain geographical segments that are really propping up the whole engine right now, whereas the majority of the country, or at least, half, a good chunk of it, is kind of hurting. And so in addition, just kind of talking about more specifically related to that, if you hear about the AI bubble and why people are concerned about it, and it's a valid concern, there has been a massive AI buildup and investment, which is of such a scale that is actually driving a fair chunk of GDP. Bank of America estimates that AI investment and AI buildup added 1.3 percentage points to Q2 GDP. Huge number. And Barclays estimates that half of the GDP for the first half of 2025 was directly attributable to AI investment. And so there you can see it's like, oh, if half of the growth of the economy is attributable simply to investment in AI infrastructure and build out, well, then it makes sense why normal people are feeling a little pain at the grocery store, are feeling some pain not having a job, not able to get a job, but the overall numbers look strong. Well, if half of it is coming from just this massive AI investment, then things start to make a little more sense. And then the other reason is that the affluent are still doing well. Roughly 2/3 of the GDP is comprised of consumer spending, and the top 10% of households based on income account for about 50% of that consumer spending. And so just knowing that, then it becomes kind of obvious like, oh, well, if the affluent are doing well and AI is pouring money into this economy, well, that can keep things humming along, even when for the average person, things aren't feeling so great and economically things aren't looking great. And that's that's what's happening. We usually touch on the University of Michigan survey, also added the Conference Board's Consumer Confidence Index. So the University of Michigan Consumer Sentiment Survey, that's a little bit better from the 3-year low of November, which was close to the lowest number they had ever recorded, but it's still down 30% for the year. So people are feeling much, much worse about the economy right now. And then the Conference Board, they do a Consumer Confidence Index that dropped to 88.7 in November. That's the lowest number in 7 months and the second lowest reading in 5 years. So this backs up what real people are feeling. People are feeling that the economy is not doing great and not necessarily headed in a wonderful direction. Though, but caveat, not to get too just jointed and all over the place. But like I said, even if we do go into a recession, if you have a job and you keep your job and you're looking to buy a house, it will probably benefit you because it will likely mean that mortgage rates will come down. All right, Federal Reserve, what happened at the last meeting? Actually, by the time the comments come in, I'll probably have to move on. So let's let's just jump again. So they met last week. Like I said, the market was uncertain as to whether they would lower rates. It was a little bit mixed, but in the end, they're concerned about the job market. They cut rates a quarter point. Not a unanimous decision, though. 6 of 19 federal officials opposed to the cut. And so it was not just a perfunctory, like I said, markets weren't certain whether they cut rates or not. So it's meaningful that they cut the rates a quarter point. But I think more meaningful coming out of that meeting was that I say QE has returned. It's not QE though. So it's not quantitative easing like back in the day of the pandemic when they were just buying like insane amounts of 10-year treasuries in mortgage-backed securities. So this is, they call them reserve management purchases. But the Federal Reserve has said that they're going to start buying $40 billion a month of treasuries, of U.S. treasuries. And so this isn't officially quantitative easing because their position and with the numbers, it's they're injecting liquidity into the market in order to keep things steady. They're essentially just maintaining. If you look at a percentage of GDP of where the Federal Reserve's balance sheet is, they're essentially just trying to maintain a steady percentage. And as GDP rises, then they have to increase their balance sheet. And there's a repo market. It's an overnight market where banks can borrow money for securing with treasuries that they then have an agreement to repurchase. Don't want to go all into those weeds, but essentially it is not officially quantitative easing. They're not going to be buying up a lot of mortgage-backed securities, but I mention it because it's still $40 billion a month in treasuries is not insignificant. And even though they're going to be shorter term treasuries, less than 3 years, it should still have downward pressure on the 10-year treasury and an impact in the bond market and result in a slight easing of mortgage rates. And so the analyst assessment of this is that these purchases, these RMP purchases, will result in the 10-year treasury dropping by 20 to 30 bips below what it would be otherwise. And kind of there'll be some cascading effects from that. And it should, like I said, some softening of mortgage rates. 10-year treasury as of yesterday or the day before when I pulled this was at 4.185. Let's take a quick peek. 4.134 as reported by the Wall Street Journal right now. Okay, now going into a little bit more of this economic data before we pop over to real estate. September's data for this is all like we're starting to have all of this government data pull in. September's data was released at the end of November. October's data was released Tuesday. So both of these retail sales were up 0.2% in September. October sales were even from September. Not what you want to see heading into the holiday season. There is a massive amount of money spent out by consumers during the holidays. A lot of businesses survive based upon that. Usually you see an uptick. We're not seeing that. We're seeing stagnant retail sales so far. These were lower than economists' expectations. And also just keep in mind that the 0.2% in September, like some of this increase is simply due to higher prices. And so these numbers are even a little lighter than you would think based upon their face value. So industrial production, we only have September data. Industrial production and manufacturing are weak. Manufacturing was even from the prior month, and the increase from industrial production was due entirely to utilities. And utilities, that's just one of those things. Usually, it goes with the weather, and that's not a meaningful increase as far as like jobs in manufacturing coming back to the United States and boosting up. So manufacturing and industrial production are stagnant. Including this in there for anyone who's joining for the first time or taking a look at the deck later. They haven't updated this since August in September. And so I'm not going to go into this again, except to say that it's just clear that DC unemployment is still higher than the national average. Estimates are that in the DMV, the unemployment rate is around 6%. It could be even higher when you look at the percentage of federal workers who were without pay for a good chunk. And then all of these deferred resignations from the Doge actions earlier on, those have been taking effect over the last couple of months. Those jobs have been coming off the books, and that those payroll has stopped for that. And there's just a lot less money in the area and fewer jobs in this area. So the DMV is definitely hurting a little bit. Okay, now let's find out what is happening in the DMV real estate market. What are you seeing with your clients for the agents out there? And if you're a consumer, if you're looking to buy a home, looking to sell a home out there right now, what are you seeing? I love to hear this kind of micro level, boots on the ground information. I can pull all the data in the world, but usually there's a little bit of a lag and it's a little bit at a higher level. And so it's wonderful to hear. Do we have anyone who has been in a multiple offer situation within the last week or two, either from the listing or buyer side? If so, I'd love to hear in the comments. Can you let us know whether it was fee simple, detached, row home, or condo, and which county it was? Also, just rough price point to get an idea, because there's a lot kind of talked about. I have the slide in here again this week, but the luxury market is doing better than the rest of the market, and so we see a little bit of divergence there as well. Temmie, what about you? I know you're like doing 8 deals a month right now, not taking any holiday time off. You're just out there grinding for your clients. So you must have about 15 examples that you can give from the last few weeks.
I do have a few examples. I did have a multiple offer situation, and again, we talked about Prince George's County and DC being a little different from the rest of the area, and so this home was in Prince George's County, and this was the best multiple offer deal I've seen for a property in a really long time in the county. We had 6 offers, very competitive, above asking, waiving contingencies. And so, which is normal for a multiple offer situation. Previous multiple offer situations, they were still asking for, people were still asking for closing cost assistance. So, so this was really nice to see. But like I said earlier,
And sorry, if you said it, I missed it. Were you representing the buyer or seller?
I was representing the seller. And I think the biggest thing that I'm seeing, even in multiple offer
Nice. That's what I thought.
situations, yeah, the biggest thing I'm seeing, even in multiple offer situations, is going under contract and then falling through because of home inspection. And so I think the biggest thing for this home is that almost everything was updated. So even though it was an older home, roof was updated, HVAC, hot water heater, all those things, which really, really, really matter now. Now the conversations I'm having with sellers is about protecting the home inspection, like anything that we can get updated, corrected, inspected ahead of time to protect that one offer that we get in is so vital. So anything that we can do to make sure that the home doesn't just look good, but actually is good is more vital now than ever before. Because I think I had
That
seven.
is so.
Yeah, I had 7 under contracts last month, and 3 of them fell, like 3 or 4 of them fell through because of home inspections. Yeah.
Mhm.
Yeah.
And we're seeing that in the data. I'll touch on that in a moment. But it's always been true. And at Fulcrum, we, with the help of Juniper Homes, shout out to Juniper Homes, we oftentimes have helped our clients with some renovations and updates because it always, with, I mean, like a proper package of renovation and making smart choices, like you're always going to get a return on your investment. And it always increases the buyer pool. There are so many people who just don't want to have to deal with it or don't understand can what can be achieved at various price points. And so by making those strategic upgrades, or like you said, taking care of pitfalls ahead of time, that has always been a huge plus for our clients. But now more than ever, I mean, when the supply demand calculus is changing and you have fewer buyers out there for every listing, I mean, if you can be that shiny diamond on the hill, that makes no sense. But I'm trying to think of what is the pinnacle. If you can be the bright spot, if you can be the best home in that area priced competitively, then yeah. And right now, when we go into that pending data, we'll see that there are a lot of contracts falling out in the area. Okay, one thing that hasn't really changed much. When you get into detail about the market, a lot is changing. I mean, a lot is changing, which we'll talk about. But when you look at overall transaction count, the market has been pretty steady for this past 3 years. You can see right now we're on pace for 49,523 transactions. Last month we were on pace for 49,750 transactions. Last year we did 49,942 transactions. The year before it was 48,950. So overall closed home sales for the DMV, we're going to hit about the same number as we did last year and as we hit the year before. But there are a lot of signs of softening dynamic shifts within the market underneath that. But part of that, don't take softening as fewer transactions. Just take that as a shift in the supply demand calculus. We're actually going to see more transactions next year. I expect that. And then also Bright is projecting that. Okay, median sales price, one thing that hasn't changed, we now have, you can see here, 30 straight months of price appreciation in the DMV. And I always just smile when I say that and kind of hit it hard because 30 straight months of price appreciation in the DMV. So if you are a buyer who's thinking of waiting to get a better deal, it kind of hurts when you have people put their purchase plans on hold and then 12 months later they're like, I can't wait any longer. And the only difference is they're paying the same mortgage rate, but they're also paying more for a home. So it's area dependent. We are seeing some softening in prices in parts of DC and Prince George's County, but overall there's still relatively strong upward pricing pressure. Year to date, median sales price is up 3.7% overall, just to give a larger picture. As we've also been seeing, though, is that days on market have been steadily creeping up. So their days on market, median days on market for the area for November were 22. That's up 9 days from last November. That's up more than a week. And we're seeing that across the board. It is taking longer for these homes to get under contract. Now, longer is relative because we've been getting under contract really, really quick for quite some time. But just know that if you're a seller, it's probably going to take your home a little longer to sell. And if you are a listing agent or you're meeting with clients about potentially listing their property, it's more important than ever to set reasonable expectations that, most homes aren't going under contract the first day, the first weekend. It's taking a little bit longer than that. Okay, now closed sales and new pendings. So this is a noticeable and meaningful drop in buyer demand for November. And it's expected, but it's still a very meaningful drop. So we had been pretty close to prior levels year over year for closed sales and pendings for quite some time. Either even or within a couple percent. And so these are the the most significant drops in closed sales and pendings that we have seen for a bit. And then also what's odd is that for October, new pendings were almost even year over year. And Temi, this is what, when you were talking about your contracts falling out, I'm going to say, wait till we get to the data, because you're going to see that the data represents this. So when you have a month that is even in closed sales or even in new pendings, and then you look at the next month and closed sales are way down, what does that tell you? It tells you that a lot of these properties that went under contract did not close. So that's kind of nuts that we would be even for pendings and then the following month be down 6.4% in closed sales. Just tons and tons of contracts falling out. So like Temi said, and we always talk about with our clients and within our team, is you need to bomb proof these contracts. If you have a listing, make sure that your floor joists aren't cracking and there's not structural problems, or you don't have an active wood destroying insect infestation. Where did we go? And then if you are representing a buyer, just make sure that your buyers are fully informed and they're aware of what's going on and their rights are protected. And, so long as everything proceeds as planned, that they truly do wish to purchase those homes. So this is also very meaningful, bigger drop than we've seen lately. This is also very meaningful because all things being equal, we should have seen a bump in buyer demand in November. If you go back to last November, mortgage rates were between 6.9% and 7.1%, kind of at the higher end of where they've been at, excuse me, lately. So last year, mortgage rates 6.9 to 7.1. Right now, they've been, like I said, in this band of 6.2 to 6.4, which is at the bottom level of where they've been at for the last 3 years. This should have resulted in a bump in transactions, in a bump in buyer demand, and it didn't. So I think this is mostly or entirely due to the government shutdown. I think this is a little bit of a blip, and we'll see this corrected. But right now, in the moment, there's no way I can say that or anyone can say that for sure. And so it's just important to keep a close eye on this. If you're counseling your clients, tell them that we are seeing some signs of the market changing, and whether that is due to temporary pressures or not, only time will tell. Okay, going into new listings. This is something else. Also a pretty meaningful change. We had been up year over year new listings for the past 2 months, and up or near even every single month since the spring. This is the biggest year over year decline in new listings in 20 months. So the last time we had a drop year over year in new listings this big was March of 2023. And so that's notable, but it's not just the decline from last year that's noticeable. This is all that's notable. This is also the lowest level of new listings, just as far as an absolute number of new properties hitting the market. This is the lowest level of new listings for November for at least 10 years. And the reason I say at least 10 years is that's as far as the data goes back that I have access to. So there was not another November in the past decade when fewer homes hit the market. And beyond that, so you can see 27 new homes hit the market in the DMV. There have only been 3 months in the past decade where fewer than 3,000 homes hit the market. So I also think that was due to a lot of people just kind of pausing things related to the government shutdown. I think we will see an increase in new listings moving forward, but still important to be aware of and make your clients aware of. Okay, active listings, though, this is kind of same old, 22nd straight month of DMV-wide increases in inventory year over year. The last time we didn't have higher inventory in a given month was January 2025, well before the current administration, well before the government shutdown, all this stuff going on. So we've been seeing more active inventory for a while. Expect this to continue. And we've also been at 30% or more above active inventory of same month prior year for 10 straight months. But want to touch on still below what I consider to be normal levels, 2019 levels. Excuse me. This number is 87% of the inventory level of November 2025. For the past couple of months, we've been between 87, 89. So getting ever so close. There were a couple of years there where we were about 50, 60% of 2019 levels. So getting closer to normal levels, but still not quite there yet. All right. leaving this slide in here for anyone who just wasn't on last month and wasn't aware, but I'm not going to dig into it too deep, other than to say Bright released their Q3 luxury summary. Luxury is defined in this area as 1.75 million and above. Luxury is doing better. More properties are going under contract and they're going for a higher price. Obviously, they're going for a higher price because it's luxury, but the price appreciation is higher than at the lower price points. Recap of all the stuff we talked about in a handy chart. And now we're going to go at county level. Break it down in a little more detail, which is important because, I mean, as you can see in this chart, and you'll see in all the charts, things are very different. If you're representing buyers in Arlington, it's a very different experience than representing buyers in DC or Prince George's County. And same thing, there's some interesting stuff going on in Montgomery County and Frederick. So it's really important to take a closer look at these areas. So as we discussed, DMV wide, we've seen price appreciation overall. And then it's no surprise we're seeing it in Northern Virginia. I've been talking about this. Northern Virginia has one of the most vibrant buyer markets. I don't mean it's a buyer's market, it's a seller's market. But I mean, there's the number of buyers relative to sellers out there. There's a lot of high buyer demand. And so that's not a shock. Arlington and Alexandria have been consistently strong with price appreciation, with new pendings, all of that. Up 5% in Fairfax as well, and then also in Montgomery County. So down in Loudoun's surprising. We'll touch more on that in a moment. Also down in Prince George's County. So the reason Loudoun is surprising, you'll see in a minute, both closed sales and new pendings were up in Loudoun, and they were up big. So you would expect to see price appreciation. And I tried to look at distribution of properties that hit the market and went under contract and sold. I mean, sales are just what goes into these numbers. But I tried to find a reason for it, and nothing seemed to make sense to me. So if we have anyone who's doing a lot of business in Loudoun County and has an idea of why the median sales price dropped when new pendings were booming and buyer demand was booming, I would love to hear that. The other thing that's surprising is DC. With 2.3% appreciation. So, I thought it would be last month. I took a closer look and I thought DC would show that detached homes had appreciated. You had some beautiful prized detached homes that sold for a really good price. And then everything else was negative, but the detached homes were carrying the day. And that's not the case. It's not the case. And I include this chart here because clearly this makes no sense. So just so everybody sees what I'm talking about, the blue is all homes, all home types. And that's what shows, the 2.5% appreciation. The red is detached homes. This purple is all attached homes. Then the green is townhomes, and the yellow is condos and co-ops. So this is something I've seen happen multiple times now, and I've asked a lot of very smart people and people who know a lot about what's happening in the industry and have connections to Bright. And I've yet to get an answer. But how can you have appreciation overall, but when you look at all the component parts, every property type is depreciating? So market stats, showing time, smart charts, MLS, Bright. If you can tell me what's happening here, I would love to know, because clearly there is something else going into this total category that is not being caught within the breakdown here. So the only thing I can think of, and if anyone knows in the chat, please drop it in there, or even if you want to speculate, something interesting to talk about. The only thing I can think of is that maybe multifamily homes are included in the overall number and not in the breakdown. And that's what's propping it up. But with interest rates and property values where they're at for, like relative to rental properties, it's like, I can't imagine there are many properties out there where you can cash flow right now. So it's like the multifamily market is down as well. So anyways, just makes no sense. So keep in mind, yes, there was price appreciation in the DMV last month, but it doesn't seem like there should be, and the data is not finding where it's at. Okay, closed sales. So closed sales down everywhere except Loudoun, like we talked about. It's Loudoun's booming, but their prices are dropping. Most of these I'm writing off as an expected result of the government shutdown. We'll see. Can't guarantee that, but it's what I saw happen. I think you could just kick November out as just being a one-off relative to the government shutdown and everything that's going on and I think we're going to see a rebound going forward. So closed sales in Prince George's County down big at 18.1%. I'm sure that number is even more depressed than it would have been without the government shutdown. But as I've been saying, the market is very soft in Prince George's County. So we would have seen a decline regardless. So new pendings are up everywhere. Except for, did I say? Except for Alexandria and Loudoun. And so that is, sorry, down everywhere. Lack of sleep. Apologies, folks. New pendings are down everywhere except for Arlington and Loudoun. And Arlington is not a surprise. Robust Nova market. Loudoun not making sense to me. Not that there wouldn't be a lot of new contracts happening, but just it's like, how do you have price depreciation? So again, I think we can knock this off to the government shutdown. We'll see in the coming months. All right, now you see so much inconsistency throughout these various areas. One place where there has not been is the median days on market. This is the one thing that's been consistent across all areas of the DMV, is that we've been seeing days on market creep up everywhere. We now have 17 straight months of increases in median days on market, DMV wide. And the last time we didn't have a DMV wide days on market increase was April and June of 2024. So, and then also, as has been the case for quite some time, DC and Prince George's County are leading the charge. Prince George's County last month had taken the crown from DC. This month, DC, excuse me, had taken it back. So DC's at 33 days. Prince George's County is at 29 days. Everywhere else is running at about 2.5 to 3.5 weeks. But just want to note, because we're seeing these numbers increase, it's median days on market. So we talked about for the area is 22. That's still relatively quick. That still means basically that half of all homes are going under contract in 3 weeks. So we're still buyer's market, DMV wide, and then inventory wise, we can see, still within the band of roughly even market in DC. And even though I talked about the softening of buyer demand in Prince George's County, based on inventory, they are still in a seller's market. Everywhere else is in an extreme seller's market. Outside of DC and Prince George's County, you're looking at inventory levels of 2 months or less. No real meaningful inventory anywhere. And in case anybody who's been following this really closely and is like, wow, inventory has been dropping from where it was, I just want to note that that's a typical seasonal drop. You virtually always see inventory dropping from October into November and December. Just a lot of people don't want to list their home around the holidays. So these drops these are typical seasonal levels for low inventory.
Hey, Paul.
New listings. Yep.
Quick question for you. So just in talking about seasonality, I had a client ask me a question. A customer asked me a question. They said, "Hey, we spoke to another realtor who said March is like the best time to sell because because when homes sold in our area in March, it's sold for a higher price." And my response was, well, the winter prices dictate March prices, right? Because you're always looking 6 months back. What are your thoughts on that when thinking about seasonality? Because I feel like right now that's what everyone's kind of saying. Like, let's wait until spring. Let's wait until March or April to sell. So what are your thoughts on that as we talk about seasonality?
Yeah. All things being equal, I agree. I think the spring is the best time to sell because you tend to have the most buyers out there. And just whenever you get more reps into something, you have a better chance of the expected result happening. So when you get into the winter and you get into, it's like fewer listings, but also fewer buyers, there's a larger chance that something could go awry, particularly if your buyer pool is small. But it's like all things being equal, yeah, spring's, I would say, the best time to sell just because you have the highest reps and best chance of things that should happen happening. But if you have carrying costs, if you've already moved out of your home and you're simply going to be paying a big mortgage for an empty house and it's a good property, then it would make a lot of sense to list it sooner. I wouldn't necessarily recommend waiting. And so it really depends on the situation. And that's one thing about, like, elite, not to toot our own horns, but elite skilled realtors at the top of our game who coordinate with renovation companies. Shout out to Juniper Homes to put your best foot forward. I mean, I have had very successful listings every month of the year. I haven't listed any properties this month, but listed properties last December and prior to December, January, and have had very, very good results. So smaller buyer pool typically, but still not a bad time to sell. And if you're going to be incurring costs for waiting, then there's a lot to be said for not waiting until then. And it's like, I would be nervous about listing like a DC condo right now because the market is so soft. I would be less nervous about listing a detached home in Arlington or some other areas. But it's also like, January, once we hit MLK Day, the unofficial start of the next year's real estate market. I mean, you have buyers coming back in, and even ones who aren't necessarily actively out there all the time, still keeping an eye on things. So there are very few times of the year where I would recommend not selling. And it just depends on whether, the cost of waiting for maybe some fringe benefits are less than the benefit you think you're going to get, or if the costs are a little higher. So yeah, none of this is a clear-cut answer, though. I think people who just say, like, don't list in December, or don't list around the holidays, or list in the spring, I mean, it's so much more nuanced than that. So great question, Timmy.
Yeah.
Going to new listings. So new listings down everywhere except Frederick, where they were up a bunch. Anybody representing sellers in Frederick, I'd love to hear from you as to what you're seeing on the ground there. But as with everything else, I think this is due to just a lot of people pressing pause with the uncertainty with the government shutdown. DC, however, is down massive. Like, DC new listings are down by a huge chunk, 21.5%. And that's continuing what had been happening last month and recently. It's just like there's so much hitting DC right now. You had all the federal employees, all Doge and uncertainty with that. And even federal employees who are still with the government. I have a lot of friends and family who are in the federal government. Even those who currently have their jobs are a lot more worried than they were in the past. Then you have huge National Guard presence. Then you have the government shutdown. There are just so many things affecting people in the District of Columbia. A lot of sellers and buyers have just, either because of the uncertainty, they're just waiting, or maybe they lost their jobs, or they're afraid of losing their jobs. And if they're if you were thinking of selling your home to purchase another home and you don't have a job, unless you can pay cash for the property, you can't get approved. And if you're a buyer, straight buyer, obviously the same thing. So yeah, new listings down, expect to see a rebound. Okay, active listings. This is another thing. There are a couple of things that have been fairly consistent throughout the area. One is increasing days on market. The other is increasing inventories. As we've been seeing for a while now, active listings up everywhere to varying degrees. But keep in mind that an increase of 30, 40, 50% of basically nothing is still basically nothing. And so you saw this already with months of supply numbers outside of DC and Prince George's County. There's no real meaningful inventory anywhere. There's such low inventory that even a bump of 50% of it is still no real increase in meaningful inventory. And in a lot of these areas, we're still not at 2019 levels. So just when you look at that, understand, don't be telling your buyers, oh, houses are flooding the market. Or don't be telling your sellers like, oh, wow, there's going to be massive competition out there because there are just so many new properties. That's not the case. More properties relative to demand in DC, much more. And then also more so in Prince George's County, but everywhere else, not the case. And then showing level, bit of a mixed bag. This kind of makes sense to me. Meaningful decline in buyer demand in DC and Prince George's County. So, the drop in showings in DC makes sense. But the increased showings, that seems to support kind of my theory that what we saw in the market was really due to a temporary force, the government shutdown. Because if you're actively looking to buy, but then something happens, government shutdown, and you think, oh, I want to put things on pause, like, you may not want to pull the trigger and commit to purchasing a home, but you'll still go out and look at homes. There's no harm in that, just in case you end up loving something more than you thought. So it makes sense that we're seeing kind of showing levels higher with pendings going down. Moving into the most recently reported data for the week ending December 14th. So this is a little, honestly, I didn't expect this. So new pendings jumped up a lot. And I don't have the slide here, but trust me, new pendings jumped up a lot in the first week of December. So new pendings first week of December were up more than 14% above the prior week. And they were up more than 3% year over year, which is what I expected. I thought post government shutdown, once the government opened and things got rolling again, we would see a bump in transactions. But then that hasn't carried on. Basically, new pendings were stagnant from last week, an absolute level, and then a drop from the prior year. New listings are back up, like those have returned, but then canceled listings are way up too. So we're not seeing, I basically saw it as these deferred transactions. When the government shut down, leading up to it, people put things on pause. During it, put things on pause, and then it takes a little while to rev back up. So I saw a bunch of transactions that I would have normally expected to happen being deferred. That's how I look at it in my mind. And then I expect those transactions to come back in the coming, month or two to basically give us the same level we would have been at overall. And we're just not seeing that yet. So are we seeing the leading indicators of a more meaningful softening of the market? Or is it just with the holidays, the time of year, things are taking a little bit longer to return? And honestly, don't have the answer to that. We'll just have to see. So it'll be really interesting to note how the rest of December shakes up. So just before we move on to next year, and we'll see the bright projections, so I do think that there are multiple signs out there of a softening market, in that I expect to see a little bit of a shift, a little bit of less buyer demand relative to listings. But overall, I expect buyer demand to increase. And I expect us to see, for most of 2026, I would expect to see year over year increases in pendings and closed transactions and all of that. And if we go here, this is the official Bright outlook for 2026. Bright expects the market to grow by almost 8% this next year. So from roughly 50,000 transactions that we're going to hit this year to almost 54,000. So that would be a sizable jump. Still a depressed market prior to this 3-year dip where we've been right around 50,000. That would still be the lowest level of transactions since 2012. So it's not like things are going to be booming, but it is expected that things are going to be returning more towards a normal level. And, an almost 10% increase in transactions is nothing to disregard. And as for those of us on here who are agents, who are in the business, and this is, our livelihood, this is what puts food on the table and a roof over our family's head. This is very positive. So just know that if you're doing okay or you're doing great, just keep doing what you've been doing, and your business should improve next year. Or if you're newly in the business, if you're just getting into it, know that this is a great time to kind of get market share. Like we say that December is kind of the pro month. It's when a lot of people are taking vacation. So if you're a new agent, just keep working, keep getting out there, hosting open houses, reaching out to leads, and you can definitely establish a strong foothold and have a great 2026. Okay, key takeaways. Oh, we're over on time. How did that happen? Must have dozed off there for a minute. My apologies. All right, key takeaways. And you'll see that a lot of these key takeaways are similar to the key takeaways from last month. And that's by design. Like, I could do a clickbait key takeaways, gotcha, hit them with these massive new interesting headlines, changing it up each month just to make it interesting. But for me, it's more important that I really just hone in on what I think is the most important thing to take away from this session. And this session is based on what's happening in the market, in the economy. And a lot of the concerns that have been the case last month and the month before are still present. So, this has been number one since I started the key takeaways. It's more important than ever for consumers to rely on industry experts, and for those of us who are industry experts to stay up on what's happening, because things are changing both in the economy and in the market. And they're also changing depending on where you are located. And so if you're basing your advice to a home seller upon what was happening 6 months ago, that may not be relevant anymore. Key takeaway economic wise is that it's just expect market volatility to continue. Just for two primary reasons. We're having all of this lagging government data come in. If it's not what the market expects, you can see some massive market movement. And then also U.S. economic and trade policy continues to be unpredictable. Stuff that was announced isn't implemented. New stuff is announced. So just a lot of uncertainty out there. So Okay, key takeaway for DC is we've touched on the DC market is hurting right now. So a lot of buyers and sellers are on pause. But what that means is if you are a buyer looking to purchase in the District of Columbia, it is a great time to buy. It is a great time to buy. You'll have less competition than ever. I mean, I can remember during 2020, 2021, I mean, even my condo buyers, we would be doing pre-inspections the day properties hit the market, multiple offers, waiving all contingencies, and still getting beat out on occasion. Whereas now, much better opportunity, much more supply relative to demand. If you're a seller or a listing agent, know your market. A lot of variance between the different markets out there and market conditions. Outside of DC and Prince George's County, still a very good time to sell. Still a strong seller's market in all core areas of the DMV, outside of Prince George's County and DC, and even in Prince George's County and DC, like Temi, sorry, Ice Temi. Like Ice Temi said, she had a multiple offer situation in Prince George's County. So you can still have success selling homes in DC and Prince George's County. Just make sure that you are getting proper counsel from an agent, or if you are a listing agent, just make sure that you position your clients for success. And lastly, pretty good overall time to buy. We're still seeing mortgage rates at the low end of where they have been at for 3 years. And even though not a lot of ton of inventory outside of Washington, D.C., there's still more than there has been. All right. That is what we got. 7 minutes over. That is not acceptable. We'll try to do better next time. For those of you still with us, I can hang around for a couple of minutes if you have any specific questions. Otherwise, I will let everyone get onto your day and I will go check in on my little girl. Also, Temi, any closing thoughts? Temi, any closing thoughts? Okay, I think I might be lagging. Maybe Temi's lagging.
No.
All right, then. Thank you all for joining. Thanks for everyone watching this later on the replay. If you are watching on replay, have any questions, just throw them in the comments and I will respond. If you want to be added to the distribution group for the deck, just shoot me an email, contact information here. Hope everyone has a wonderful holiday season, and we will see you all next year. Take care.